All right, good morning, everybody, and happy Monday. Where's the camera? I think here it is. Hope you guys had a good weekend and are ready to tackle a fresh week. We have a whole bunch of charts here that I'd like to start the week off with. I think is going to give us some really good perspective here to get started. So we will do that here in just a minute. And thank you all for confirming the audio and visual. I would say let's get started to remain on time. Again, good morning, everybody, and happy Monday. It's Serge Berger here from thesteadytrader.com. This is our morning call. And we are going to spend the next 10 to 15 minutes going through some of the top things on our radar. If you are here for the first time, as always, please make sure you subscribe to the channel. It's free, of course, allows you to be updated in real time when we go live with analysis and insight. Also, please make sure you give us a thumbs up like on all our videos so that the algos pick us up. So let's get started. We have a full trading week ahead here starting today on Monday. The first thing that we are going to be faced with this morning is going to be options expiration hangover. And so if you look at the board last Friday, we had just a ginormous options expiration week day. It was quadruple witchings options expiration, which basically means that both options and futures expired and were rolled. And so typically you come into the Monday where now today we are going to have a bit more hangover of that, right? A little bit like a party hangover. And so we need to deal with that, which is to say that we could see a bit of choppy price action here this morning before maybe the truer picture tries to kind of come to fruition. I can tell you, I've been watching the overnight markets here for the past couple of hours, and you can see the equity market struggling to find its way because there's still a lot of confluence there, whereas the truer risk assets that are less manipulated by order flows are weaker this morning. So that's that. So I want to start off with a chart here that I think I would be remiss not to show you. And actually, I have to create it. I thought I had it, but I don't. So well, actually, first, let's start off with what we promised we would start off with every morning here, and that's again the continuation of the reminder that yes, everyone's long Max 7 stocks up to here. The reality is that the markets are not led by that, right? Markets are led by hard assets year to date. If you look at this chart here, you can once again see that and be reminded of it. And that is that gold mining stocks year to date are up 113%. Are they getting overbought? Yes, I think. You look at something like ticker symbol B, that stock has gone completely vertical. But uranium is doing very, very well. And these are the assets you guys have hopefully heard us talk about for the past, 9 to 12 months. And indeed, they are really, really badly beating the Max 7 complex. And that's because we're moving into a harder asset type of portfolio. So the portfolio that's worked for the past 10 to 15 plus years is most likely not going to do not even nearly as well as it did for the past, again, 10 to 15 years. So I would think going forward we need a different portfolio. And this year we're seeing, I think, the emergence of that trend. Max 7 stocks, yes, they're doing well. They're up 20% on the year. But again, many other things are doing way better. So, and that's just the beginning, right? We think ultimately we're going to see flat performance of things like Max 7 and continued performance, maybe not at the rate at which they have. I don't expect gold miners to rally at a clip of 110% every year. But again, I think the trends are there. So that's important. Now, I want to lead off with a couple of big picture charts. The first one here is actually this one here, and I will get rid of this one afterwards in the interest of space. I have a little bit of limited space here. We're finally moving back into our main office this week. So I'm looking forward to that. I'm not sure to what extent I can display it yet, but we are moving in there later on this week. So I'm still kind of jumping around here. In the meantime, what you're looking at here is something really interesting. This looks like a bunch of squiggly lines, which it is. But at the bottom, you'll see the x-axis at the bottom basically stretches back to 2017. And basically what this is the pace at which hedge funds are buying basically technology stocks, right? Basically Max 7. And you can see we're right here. So basically this is like probably the second fastest pace ever. That does not mean it's the end of the world, but it tells you that it's been happening into options expiration, which of course we just had on Friday. And so it's just important to keep that in mind. And it's likely a catch-up game that we saw into options X. And so to me, I don't chase charts, as you guys probably know, so I want to be careful of these kinds of moves when I see them. So I just thought I would point that out. Quick side notes, my colleague Christian is here, and my colleague Joel as well. It's a full house. Christian just posted a link into the questions box or chat box, whatever it's called. If you are interested in using options from an income perspective, we have an options income strategy we like to use. If you want to learn more about how to use options for income-oriented type of trades, make sure you join us in a special presentation that I'm going to be doing on Tuesday. It's very well attended when we talk about options usually. I think this one's going to be probably a full house and might actually limit up to the point of where the room might sort of peak. And then, so if you were interested in that, just sign. It's obviously free. And if you want to learn about how to use options for income, then I would encourage you to sign up for that session. It's just a training session on a strategy that we like to use in the options market. But speaking of options market, again, just quickly back to this chart here, what you can see again is hedge funds buying tech stocks at the second fastest pace. It looks like basically since 2016 or so. And again, that's a little bit something that, it's no reason for me to jump out a window or go short the market, but it just further confirms that what we've been seeing here is a real melt up. So that's one thing that I wanted to show you. We're going to come back to some stocks that as a result have gone very far. But I want to first show you a chart that I believe everyone should be aware of. And I'm going to just quickly, I have to recreate it here. If you give me just 1 second. It's this one here. Here we are. All right. So the chart is this one here. This is the 95-year chart of the S&P 500. This is a 95-year chart. So I'm using what's called a logarithmic chart for that, because if you use a regular arithmetic chart, it's going to, well, here, if I were to use a regular chart, it would look like this. That's not very helpful, right? So we have to use what's called a logarithmic chart. We can talk about what that means a bit more in the future. But what you're looking at here is essentially the S&P 500 having reached a point now that it has only been at basically 3 times before. One time, of course, when this line was the first point was able to be drawn, which was basically right at the peak before we had the Great Depression stock market collapse, where it collapsed like 80%. That's not my forecast, okay? So don't get me wrong. The second time this happened was right at the peak of the internet bubble, where the stock market then first of all drew down about 55-60%, but more importantly went sideways for the next 13 years. The third time it happened was right basically after COVID, so basically at the peak of late 2021 heading into 2022. And then of course in 25 the market drew down about 25%. So, and we're now up here again and we're trying to overshoot, which is again a function of global liquidity coming into the market in an unprecedented way. Quite frankly, the US is now has actually now added a lot to its deficit of the year to date. Deficit spending here in the United States, but also, of course, we have the globe stimulating fiscally and monetarily by cutting rates and by spending money. And that's really why equities are going higher at the rate at which they have. The question is, when liquidity gets withdrawn, which is likely going to happen at some point in the next 6 months, and the market will sniff that out beforehand, we then could be at a point where it's not about stock market crashes, but the market might stop going higher, just as everyone is very bullish. There was a really big, I'll give you guys a fun fact here. There was a really famous conference that took place 2 weeks ago, I think it was, in California. I don't want to mention the name because I don't want to get added at. But it's been televised, it's everywhere on financial TV. And I was fortunate enough to talk to a friend of mine last week, and he said he attended. And basically the consensus by all these people that are basically all making money from from selling ETFs and selling products around Max 7, basically the over and under was buy more Max 7 stocks, because they're all vested in the bubble basically continuing to blow higher. Now, again, this doesn't mean that NVIDIA has to start crashing. It just means that at some point there will be no more money to allocate to the few stocks they're allocating money to. And when I see hedge funds piling in at a record rate, as I just showed you, the S&P at these levels, and I'll show you a bunch of other charts in a second, it's just, again, it's not meant to be a fear-mongering call, right? I think you guys know that by now. It's meant to be a risk management call. And I see very few people willing to risk manage now. I talk to people every single day, from, hedge funds to retail investors with a lot of money, retail investors with almost no money, and everyone's basically doing the same thing. The smart money is doing it a bit differently because they know they have to be hedged. They can't afford big drawdowns. The retail investor thinks they can afford the big drawdown, thinks that it happens slowly, and will probably be wrong on both of those terms. So anyway, hopefully this is helpful on the long-term chart. Is this S&P chart at all helpful, or is that not really that important? I would love to get some feedback on this while I give you guys a couple other things here to ponder about as we start the week. The other thing I wanted to bring about is this. Give me just 1 second. I'm trying to make this chart smaller. I wanted to show you two charts. I wanted to also show you JP Morgan. This is a chart that I've been showing for quite some time now, and I think it's just becoming more and more important. This is shares of JP Morgan. They are basically they are the market, meaning they have about a correlation of 1 to the S&P 500, and they are also at the very, very upper end. And if you were to overlay the S&P here, again, I've shown this before, right? So this is nothing new, but it's the same chart. The S&P and JP Morgan is the same chart. So that's another thing. Aside from that, there are two types of things I wanted to quickly mention. Number one, have you guys looked at restaurant stocks at all? Restaurant stocks. Restaurants, like, if you eat, you should probably worry. Not worry is the wrong word. If you eat food ever, you probably have a decent idea of what's going on when you go to restaurants. What you may not be aware of is how the restaurant stocks have been doing. So, for example, you take the Cheesecake Factory, which, if you use our trender indicator, which I will quickly show you here, you would have received one hell of a momentum sell signal just a few weeks ago. Okay, so this is how the trender works. So if you have the trender, please use it. If you don't have it, please get it. So we had our sell signal, and so far the stock's down about 12%, a bit more. So that's not exactly the sign, and there's all sorts of other stocks are doing this as well. Like, for example, all the names are just not right now. It's or now kind of getting over my head, but all sorts of restaurant stocks are doing crappy. Even stuff like Cracker Barrel, which is not a great reference point. But anyway, so restaurant stocks are, to me, are a bit concerning what they're saying. It's not meant to be, again, a fear-mongering comment, but it's just what's happening. Now, let me show you a few things that have gone vertical. I'm going to show you a few names that I think everyone should be aware of, and these are very, very popular names that are very crowded. So you look at a stock like AppLovin. I still, every time I hear that name, I have to cringe. But this is a stock that, and it can continue, but if you look at a stock like AppLovin, it's acting in an extremely unnatural way, the way it's trading. It's done this before, right? So, for example, it did this back in 2024, so about a year ago, and then it had earnings, and then it was basically done for, like yeah, like 9 months. But it's the way it's getting bid up is clearly machine led, right? So you can see like this kind of move in the stock. This is not exactly a very healthy type of price behavior from the perspective of price discovery. There is no price discovery. And so I would expect something like this to be able to mean revert. Just like you look at something like OKLO, this is a company that, again, there's just no price discovery over the past, certainly month to date, right? The past couple of weeks. And to me, you know, when I see that kind of stuff, that's quite concerning. So anyway, I mean, that's a lot of stuff here to start off the week. So hopefully this is helpful for you guys to give you a bit of framework within which to work here as we start off a new week. Again, I'm going to leave you with the S&P chart here, which I think is probably one that many of you can kind of get your head around. But if you have any questions, otherwise let us know. Again, please make sure you give us a thumbs up, like on all the videos. Leave some comments if you can. And please also subscribe to our YouTube channel. Obviously, it's free. We put a lot of work into this between the videos, these morning shows, posts, you know, even vlogs and all sorts of stuff in YouTube Shorts. We want to make sure that everyone's educated and thinks in terms of risk management as opposed to you know, greedy kind of behavior, which ultimately won't end very well. So thanks all for being here. If you guys report a trade-a-thon, we'll see you in about 15 plus 10, about 25 minutes or so. Have a great start to the week, and we'll also see you back here tomorrow morning.